You ever heard of this term cash flow, but not really sure how it makes sense when it comes to your business? Well, in this video, I'm going to break down a simplified version of how to think about cash flow and how you can apply it to your business. Hi, my name is Morgan Whalen. I'm a fractional CFO, and I work with small business owners every single day on things just like this. So if you're ready, let's go ahead and get started.
So the first thing we're going to look at here is the dates. So in this cash flow template that I'm using, I'm doing this on a weekly basis now. If you're a smaller company, you can do this on a monthly basis. If you're a bigger company, you can do it on a daily basis if you want to. We start our weeks on Monday, we end our weeks on Sundays. You just need to get into a formal way of however you want to track it. And so the main features of this template are one, the start of week cash. So for us, we'll look every Monday and pull their bank data to see, okay, how much cash is in the bank to start the week. And then the first thing we'll then do is look at our inflows. And so I'll talk about this first, and then we'll go into our outflows next. So from a cash perspective, inflows means things that enter your bank account for cash. For most businesses, the biggest thing that's going to enter their bank account is revenue. Or if you're doing accrual accounting, then you'll have accounts receivable. But it's essentially the money that's coming in from your operations of your business. So whatever it is that you do, whatever it is that you sell, whether it's a product or a service, whenever people exchange money for that, then it's going to be coming in through revenue. And for this, again, it's a simple template. But if you had multiple products or services or tiers, then you can break down revenue by tier of service if you want to get to that level. But typically for a simple cash flow, you don't need to get there. The second one we have here is credit cards. And credit cards, when you purchase something on a credit card, you're purchasing it on credit, meaning you're not using your money at the point of sale. You actually use your money to pay off the balance of the debt that you owe the credit card company once a month. So on the day to day, you're spending money on the credit card and you're using someone else's money or the other company's money, which you then pay off at the end of the month or whenever your statement cycle due date is. And so you have credit cards here. And so you're paying with other people's money. So you're really borrowing other people's money. And so we track it as an inflow. Then you have loans. So think of SBA loans, short-term loans. The other thing would be owner's contributions or personal funds or things that, if you need to fund the business in the beginning with your own money to get it off the ground, then that's where we'd be tracking this here. And then other income. So other income could be from the sale of assets or from credit card reward points, things like that. So these are the main categories that you have for inflows that will have money coming into your bank account typically. And so once you have these numbers here, then you can have your total inflows for the week. And so these numbers are typically based off what historically you've done up to this point, and then also taking into account any growth or projections that you may have about upcoming weeks. So if you recently did a new campaign and you expect a lot more to be coming in, because you see the numbers already, right? There's more people that are going to your website. There's more people that are clicking on and moving down your customer journey. Then you would say, okay, maybe we can increase this later on. But if you see that your leading indicators are actually going down or staying stagnant, then you would adjust appropriate based off the numbers that you're seeing. Now, the farther you go out, the less accurate this is. And it also depends on your sales cycle. So if you're a big company, enterprise company, sales cycles could be, 6 months, 12 months, even more longer, right? Because they're big contracts. If you're a small company, then this could be, a few days between when they see your, let's just say you have advertisements between when they see your advertisements and when they purchase from you, or maybe same day, right? So depending on that will determine how far out you can look on a cash flow statement accurately. But for most small businesses, I would say, anything past probably 30 days, 60 days, you're really guessing more than you are knowing on your cash position, just because you have no idea looking out that far if you're going to still be doing the same things you are today, 2 months from now, 3 months from now. If you have a pretty consistent acquisition channel already made, then you can be a little bit more consistent with the numbers that you're seeing here, especially when it comes to revenue and forecasting that out.
If you're enjoying the content and you want even more, I write each and every week in the Financial Focus newsletters ways that business owners can tactically apply methods, proven systems, and things that I've learned over my years of helping business owners in their business to help increase their cash and reduce their expenses. So if that sounds interesting to you, go ahead and click the link below and sign up for the Financial Focus newsletter today.
The second thing we look at after our inflows is our outflows. And so this could come down really into two main categories, which is fixed and variable. So think of fixed cost are things that happen no matter what in the business. So if you don't run your business at all that month, or you run your business, you still have to pay these expenses. And so this could be rent, insurance, full-time payroll, all those things, whether you do a dollar in sales or not, you still have to pay those. Now, everything else is considered a variable cost, and these usually fluctuate with sales or with an increase in staff. So, payroll, which is part time and independent contractors, which I have here, this is variable because you set how many hours they work each and every week, month. You get the idea. And so, you can change this as need be. So as demand fluctuates for your good or your service, you could say, hey, we need, we definitely need you here more hours, or actually, it's slow. So we're going to cut your hours back. The next thing we have is sales and marketing. So you can ramp up your spend on whatever it is, social media, advertisements, commissions that you may be giving your team, things like that. Software and apps, I think that's pretty self-explanatory. Business and admin, other expenses. So you get the idea. You have all of your expenses. Those are money leaving your bank account, whether they are fixed or whether they are variable. Then you have things that don't show up as a typical expense, but you want to account for them too. So this could be like, again, what we talked about earlier, which is a credit card payment. You're going to have to pay that balance off eventually. And so once a month in this example, on the 21st, you would have to pay off whatever the statement balance is, or your minimum balance, whatever you decide. And so you'd have that there. And then, another way that you could have money leave the bank account is if you buy an asset. So if you buy a car with cash, that could be money leaving the bank account. Or if you put a down payment on something, or machinery, or you buy inventory, you get the idea. But this is variable, so you can determine how much you are spending on that thing. It's not a fixed cost typically. So you get the idea. You have your inflows at the top, you have your outflows. You adjust this to your business, and you want to keep it rolled up as much as possible. You don't want to have every single line item here. You can see how I just have a few of the main ones that a business would typically have. So once you have that, you're gonna have your total outflows, and then you're gonna have your end of week cash. And you can see this goes along. And again, the farther you look out on this, I would say the less accurate it is. But you can look to see, okay, what's going to be our cash position this month, next month. And I would say max, you maybe want to look out up to 3 months. But you can see here, like you have a negative month coming up, right? At the end of April, beginning of May, they're negative $4,000. Okay. So that's when you could start planning ahead of like, okay, if I know I'm going to have this slow month, what can I do leading up to it? Maybe you got a seasonal business, and April going into May, everyone's leaving for school, and your business is hurt because you're not going to have your normal clientele or your normal foot traffic, like whatever it is. And so maybe you go in here and you say, hey, I'm going to cut my part-time and independent contractors down in half. So from this 10,000 that I thought we were going to spend, we're just going to keep it 5,000 and 5,000. And so this is one of the easiest levers that you can pull. And so I'll adjust those two things, and now went from negative. Now we have at least $5,000 cash to get us through maybe the slow month. And so that's one way that you can look at that, right? Because you're like, okay, I just need to cut a little bit more leading up to it. I think demand will stay, relatively the same throughout, but I can cut the hours in half and then have enough for my team, specifically during this month where originally it was going to be going negative for us. Another thing to consider when you're looking at your cash flow, and as you get bigger, right? In the beginning, it may not be as big of an issue, but as you get bigger, you're going to notice like a lot of your bills are clumped around like certain days. And so then that forces you to have a lot more cash on hand. Where if you had it spread out between all of the weeks, then you can have a little bit less cash in the bank consistently, like to have so much in at one point by spreading out your costs. So maybe you talk to your landlord and you say, hey, can we move the rent from the first of the month to the fifth? And so then that would move this one over. And so now you didn't have to have $62,000 in the bank account. Now all you need is $57,000 in the bank account for this week. And then you moved it over 1 week to a slower week with expenses. So that's another way where you can massage it and you can get pretty consistent. Then you don't have to have extreme spikes or a large amount of cash at one point, and then the next month or next week it's like nothing, and then large. You want to try to flatten it out as best as possible and get a bit more consistent when you can. Now, payroll's typically gonna be your biggest expense. You can't really get away from those, but everything else, look to see if you can stagger it to help even out the cash flow or the cash that's going to be required from you. Um, Another thing too, like if you're struggling with cash, one of the suggestions I usually have is, okay, well, can we lean on credit cards for a little bit? So in that same example where it was negative, $5,000 over here, is there something that we could do? Maybe we could put a little bit more on the credit cards for the next month or 2 months leading up to this. So then that way, instead of paying those off, we hold a balance, we incur a little bit of interest, and then we can have the money on hand to pay for this month where we have a lot of expenses going out and we don't anticipate just through normal operations that we can pay for it. Now, when you get into those types of scenarios, you're gonna have to do one of two things eventually, right? That's a short-term fix. So you either have to grow out of this cash flow issue that you're having and or you need to cut expenses. And so growing out of it could just be more demand, growing out of it could be selling more units, growing out of it could be keeping people longer buying, growing out of it could be increasing prices. You get the idea, but essentially you want to be able to generate more cash coming into the business through whatever, method that you find works best for your company in the stage that it's in to be able to get over those cash flow issues. And so you got to find within your business where that is for you. It could be maybe the acquisition side, right? It costs you so much to acquire a customer, and it takes you 2, 3, 4, 5 months to get the money back to then be able to spend to acquire the next customer. So if you have that issue, then you're like, okay, how do we change our acquisition process, or how do we lower our costs, or make the customers worth more so we can recoup that cash quicker to then spend on that next acquisition? So you get the idea, but at the end of the day, this is here to help you so you could start seeing into the future of what's my cash position now? Where do I see these upcoming hurdles or obstacles? And what can I adjust? Because the farther out you could see it, the less of a sharp turn you have to make, the more you can kind of guide to that outcome that you're looking for. So, hopefully this is helpful. If you're finding this useful and you want to use a template like this, I will leave a link in the description down below to where you can get a copy of this exact Excel sheet where you can plug in your numbers and start looking at a month, 2 months, maybe even 3 months out to see where do you feel your business is headed from a cash position. And you definitely want to look at this separately than like a P&L or balance sheet. So if you're looking at those two things, they're only going to give you kind of part of the picture, and you want to treat your cash separately. So, on your P&L, it could say you had a profitable month, but if you look at your cash position, you actually went down in that month. Well, why did that happen? Okay, well, you could look here and see what was going on even even more in depth than a regular statement of cash flows would get you on your accounting system. Because in here, it's going to have everything from your balance sheet and your profit and loss all combined into one. So this is the advantage of using an Excel sheet, because now you can see it all in one place instead of having to pull up multiple reports and see how they link together and all that kind of stuff. So hopefully this is helpful. Again, if you want, I'll leave it down in the description below. But yeah, let me know if you have any questions on this. What was your main takeaway? And yeah, let me know. And so if you enjoy these types of videos, don't forget to like, subscribe, leave a comment, and I will catch you on the next one.